Hey, welcome back. My name's James Johnson, and my expertise lies in retirement and estate planning. And today I want to talk to you about qualified money. And qualified with who, I guess the question would be. Well, the answer is it's qualified with the government. And there's all types of qualified money. There's pension plans, stock bonuses, SEPs, IRAs, 401ks, thrift savings plans, ESOPs, KEHOs, 403bs, 401as, the list goes on and on and on. And the reality is of qualified money is that your business partner is the government. Now, I don't know how you feel about that, but I'm not a big fan of the business partner being my business partner being the government, that is. So what do qualified plans do? Well, basically they do two things. They defer the taxes, but really what they do is they postpone the tax. So not only do they postpone the tax, they also postpone the tax calculation. So when it comes to qualified plans, the real question is, what tax bracket will you be in when you retire? And I teach seminars all the time, and I always ask this question: what tax bracket do you want to be in when you retire? Do you want to be in the lowest tax bracket or the highest tax bracket? And the reality is if you think about it, you really want to be in the highest tax bracket, paying the least amount of money. Because if you're in the lowest tax bracket, what that really means is that you made no money at all. Or you managed to get all of your money over to tax-free, and it's a pretty good chance that it's not going to be the case. Now, the second question you've got to answer is, what deductions will you have when it comes time to take your money out? Or what is your exit strategy? And the reality here is for most people, they're running down the road with one foot on the gas and the other foot on the brake. So they're paying off their house as fast as they possibly can, and they're deferring taxes out to a point in time where they believe their tax rates will be lower. But simultaneously, they're kicking the kids out of the house, getting rid of one of their largest tax write-offs, and then when they hit retirement, they're no longer going to put any more money inside of their qualified plans, which is their third largest tax write-off. So they just got rid of their three largest tax write-offs, and more often than not, these people end up in the same tax bracket or a higher tax bracket going forward when it comes time to retire. Now, often they end up in a lower tax bracket between, say, 60 and 67 to 70, 71, 72, but then at 72, this magical thing happens, and it's called RMDs, Required Minimum Distributions, at which point in time you now are going to take those out at probably a higher tax bracket than you were before, pay more on your Medicare, pay taxes on your Social Security, and all about your other known incomes. Now, let's talk just a little bit about tax history, and then we'll go talk about that further in the future. And if you've heard me talk before, you've heard me say this over and over and over again, and that is, what's the highest income taxes have ever been in the United States? And the answer to that question is 94%. The average has been 56.94% since the inception of the temporary income tax and the establishment of the IRS, and currently we're sitting over here at 37%. Now, that being said, if that's all you knew, it would be no big deal, but let's talk about the national debt clock, which is currently $30,649 billion, and down here in the bottom, in the unfunded deficit down here for Social Security, Medicare, and prescription drugs, we're $171 trillion upside down. You put those two numbers together, about $201 trillion upside down, and on top of that, we have a national budget of about $4.4 trillion, of which we spend $1.6 trillion more than we're actually bringing in. Quite a lot of trillions, don't you think? Well, everybody I show this to and everybody I talk to about this, they all say the same thing. In the future, which way do you believe taxes are going to go? And their answer is always, taxes are going to go up. Now, I don't know what you believe, but I believe taxes will be higher in the future. And my real question for you is, do you want to pay them? Now, some other interesting facts about that I rarely show you are the tax thresholds. So if you look throughout history here, you can see our initial tax rate when we put the temporary income tax in place was 1%. So if you were making $20,000, you were paying 1% in taxes. Your top tax rate at the time was 7%, and you had to be making $500,000, which was a pretty considerable number in the year 1913. Now, if you follow this, it goes $500,000 threshold for the highest, $2 million, $1 million, and then all of a sudden, right here in 1921, we went from a $1 million threshold to a $200,000 threshold. Jump back to 500, back down to 100. Then we jumped to a $1 million threshold here in 1932. $5 million threshold, and then literally overnight in 1941, when we got to the highest tax rates that we'd ever been in history, we went from $5 million threshold to a $200,000 threshold. Then up to 4 and 2, and you can see as we go forward here that actually the threshold here for the 28% tax bracket was only $32,450 to be in the top tax bracket which was 28% back in 1992. Now, what's the purpose of looking at this slide here? Well, the purpose of looking at this slide here is to understand that the government can do pretty much whatever the government wants to do, and whenever the government wants to do it. And more often than not, that's exactly when you don't need them to do it. It's when you're in the distribution mode and then you're paying a higher tax rate. So let's talk about how qualified plans postpone the taxes and the tax calculation. So we'll just use a standard calculation here. For most people, they're putting in $7,000 a year into their qualified plan, and some are putting much more, some less, but we'll just use an average number here. And let's say that your current tax bracket is 30% and your withdrawal rate is 30%, and the years until withdrawal are 30 years. And you're going to invest your money and you're going to make a steady 6% rate of return. Now, what do we know? We know that that's not going to happen. We know the market's going to go up and go down. But for the purpose of this class and understanding exactly how these taxes works, we're going to use a static return. So using that calculation, you can see here that our account balance at the end of that 30 years would be $586,612. Of which the portion that's actually your share. Now, what do I mean by your share? I always laugh when a person says, I have $1 million in my 401k, and I always say, well, can I see your after-tax statement? And they say, after-tax statement? What are you talking about? Oh, they didn't send that to you? Well, let's talk about what it's actually going to cost you to get it out. And in this case, it would be $175,984, all right? And the taxes that they saved on contributions was $63,000. So by putting that money in, $7,000 a year, every year for 30 years, they saved $63,000 in taxes so that they could pay $175,984. Doesn't look so promising when you look at it like that, does it? Now, how does your tax bracket at withdrawal affect your anticipated returns? So if we look here and we can see that our annual contribution $7,000, we're going to match at $2,500. Well, when we do that right here with the 6% rate of return, in the first 10 years, our actual rate of return over that period of time turns out to be 7.25, because that $2,500 we're not putting in, our company's matching that for us. And as that accumulates over time, it becomes 8.04 over that second 10-year period of time and 11.37 over the third. And our average over the entire period of time is 7.62%. Now, going back and looking at our tax rates again, what do you think is going to happen to taxes in the future? And the reality is that they're probably going to go up. Now, if we look at that annual contribution and we talk about how do traditional qualified plans compare to a Roth qualified plan, and we have an annual contribution of $7,000, our current tax bracket is 30 and 30, and years till we withdraw is 30 and 6%. We're running an apples to apples comparison. Now, if we're going to do an apples to apples comparison, then we have to consider this thought. If we put $7,000 in a tax deferred account, then our contributions will be $586,612, and the amount due to the IRS will be $175,984, and our net amount will be $410,628. However, if we contribute an equal amount over to the Roth IRA, then we have to assume that we paid that 30% in taxes on day one. So we can't contribute $7,000. We're only going to contribute $4,900 to have an apples to apples comparison. Our total contribution over that period of time will be 400, not the contribution, but our total growth over that period of time will be 410,628. We'll have zero money owed to the taxes, and we'll have a net amount of 410,628. So what does this mean? This means that if I defer taxes today at 30%, or if I pay the taxes today at 30%, and my tax rate is exactly the same when it comes time to take it out, then my account value will be exactly the same. So do you believe that you will be in a lower, higher, or the same tax bracket when it comes time to retire? And do you believe that taxes will be lower, higher, or the same when it comes time for you to retire? Now, most people are very surprised to learn that in order to retire, they're going to need an equal amount of money to what they were living on today, and their tax bracket will be equal, if not higher, in the future. And incidentally, if you're married, it's almost guaranteed that one of you will be in a higher tax bracket, because what's going to happen is one of you are going to die, and now the other one has to file single, tax bracket goes up, and you did a better job of planning the government's retirement than you did your own. So when we go out over here, how do the qualified plans compare to, say, a taxable account? Because remember, there's three ways to grow our money. We can grow our money tax as we go, tax deferred, and tax free. So if we go out here, we have an initial account of zero, and we're contributing $7,000 a year, and the company's matching $2,500. Then our current tax bracket, all the same numbers we had before. If we do that over that period of time, then it's $796,116. Taxes due is $557. But if we make that same $7,000 contribution into a plan that's taxed as we go, we ended up with only $296,116. So the question is always, is it better to grow my money tax as I go, tax deferred, or tax free? And the answer is, it's always better to grow your money tax deferred or tax free over tax as you go. And whether it's better to grow your money tax deferred or tax free is determined by what rate are you going to pay when it comes time to take it out. So, important questions to ask. What tax bracket will I be in at retirement? And if you haven't taken the time to sit down with us and let us show you what your retirement looks like based on your current plan, then you're probably going to be very surprised to find out what tax brackets you're really in. And often, you don't even know what tax bracket you're in now, so how could you determine what your tax bracket is going to be in the future if you haven't taken the time to learn that? The second question to ask here is, what deductions will you have when it comes time to take it out? And then the third question that you have is, what is your exit strategy? How do you plan on taking your money out? You see, when it comes time to take the money out, you always want to do what are called tax-wise distributions. So I guess the real question that comes down here is, have you been planning your retirement or the government's retirement? And the answer lies in whether you have a solid plan and whether you know whether your plan's working or not, and what your exit strategy is to know which one of those makes the most sense. So remember to subscribe to our YouTube channel below. Remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. And I look forward to seeing you again real soon.